Want to learn the 7 investment rules that made Warren Buffett one of the richest men in the world? Let's dive in. Warren Buffett is a household name when it comes to investing. He is known as the Oracle of Omaha, a nickname that emphasizes his immense knowledge and experience in the world of finance. Buffett is one of the richest men in the world, with an estimated net worth of over $100 billion. He has built his wealth by following a set of rules that has worked for him over the years. In this video, we will explore the 7 rules that Warren Buffett believes are essential for successful investing. Rule number 1. Invest in what you know. Warren Buffett's first rule of investing is to invest in what you know. This means investing in companies whose business models and products you understand well. For instance, if you work in the technology industry and have a good understanding of how it works, then you can invest in tech companies with more confidence than a person who doesn't understand the industry. Buffett believes that investing in companies you understand, helps you make better investment decisions because you can analyze their strengths and weaknesses with more accuracy. Moreover, investing in companies that you have a good understanding of helps you to avoid the risk of investing in fraudulent or poor managed companies. Investing in what you know also means avoiding investing in trendy companies that you don't fully understand. For instance, investing in cryptocurrencies or other trendy but volatile industries without a proper understanding of the market can be risky. Rule number 2. Value investing. Warren Buffett is a value investor, and his second rule of investing is to practice value investing. This involves looking for companies that are undervalued by the market but have strong fundamentals, such as earnings, assets, and liabilities. Buffett believes that the stock market is often inefficient and that investors can capitalize on this inefficiency by finding companies that are trading below the intrinsic value. Value investing requires a lot of analysis and research to identify such opportunities. One of the key advantages of value investing is that it minimizes the risk of investing in overvalued companies. When a company is overvalued, there is a risk of the market correcting itself, causing the value of the stock to drop. On the other hand, when a company is undervalued, there is a higher potential for the stock price to increase, presenting an excellent opportunity for investors. Rule number 3. Margin of safety. Warren Buffett's third rule of investing is to always invest with a margin of safety. This means buying stocks that are undervalued and have a low risk of loss. Investing with a margin of safety involves determining the intrinsic value of a company and buying its stock at a price significantly below the value. This provides a buffer against the market fluctuations and reduces the risk of loss if the stock price drops. Margin of safety is particularly important in investing because the future is unpredictable. Even the most successful companies can face unforeseen challenges, such as economic downturns, legal issues, or technological disruptions, which can negatively affect their stock prices. By investing with a margin of safety, investors can prepare for such events and minimize the risk of loss. Overall, investing with a margin of safety is a key investment principle that can help investors to minimize their risk of loss and increase their chances of success in the stock market. By following this rule, investors can prepare for unforeseen events and take advantage of undervalued stocks. Rule number 4. Long-term focus. Warren Buffett has a long-term investment horizon. He believes that investors should have a long-term focus when investing in stocks. This means investing in companies that have strong fundamentals and holding on to them for a long period of time, over the years or even decades. Buffett believes that the stock market is volatile and unpredictable in the short term, but tends to follow a positive trend in the long term. By focusing on the long-term prospects of a company, investors can avoid getting caught up in short-term market fluctuations and make more informed investment decisions. Moreover, a long-term focus allows investors to take advantage of the power of compounding, which is the process of reinvesting profits and earning returns on those profits. Over time, the power of compounding can significantly increase the value of an investment portfolio. Having a long-term focus also means avoiding the temptation to make impulsive investment decisions based on market rumors, hype, or fear. This requires discipline and patience, as it may take years for an investment to reach its full potential. Number 5. Patience. Patience is crucial in investing because the stock market can be volatile and unpredictable in the short term. Stocks can fluctuate wildly on a day-to-day basis, but over the long term, the market tends to follow an upward trend. Buffett believes that investors should take a long-term view and be patient when it comes to their investments. This means holding on to stocks even during periods of market downturns, rather than selling them in a panic. By having patience, investors can wait for the market to rebound and capitalize on the long-term growth of the companies they have invested in. Moreover, patience can also help investors to avoid making impulsive investment decisions based on emotions such as fear or greed. When investors act out of fear or greed, they make rash decisions that can negatively impact their portfolio. However, by staying patient and sticking to the investment strategy, investors can avoid such mistakes and make more informed decisions. Rule number 6. Avoiding emotional investing. Warren Buffett's sixth rule of investing is to avoid emotional investing. Emotions such as fear, greed, and panic can lead to impulsive investment decisions that can negatively impact an investor's portfolio. One way to avoid emotional investing is to have a well-defined investment strategy that is based on solid principles and research. This means avoiding the temptation to make impulsive decisions based on rumors or hype, and instead taking a methodical approach to investing. Another way to avoid emotional investing is to focus on the long-term prospects of a company, rather than short-term market fluctuations. By focusing on a company's fundamentals and long-term growth potential, investors can avoid getting caught up in the emotions of the market and make more informed investment decisions. Moreover, investors can also avoid emotional investing by diversifying their portfolio. By investing in a variety of stocks across different sectors and industries, investors can minimize their risks and avoid the emotional roller coaster that comes with investing in a single stock. Rule number 7. Diversification. Finally, Warren Buffett's last rule of investing is to diversify. Diversification means spreading out investments across different stocks, sectors, and industries to minimize risk and maximize potential returns. By diversifying their portfolio, investors can avoid putting all their eggs in one basket and minimize the impact of a single stock or sector on their portfolio. This means that if one stock or sector experiences a downturn, the other investments in the portfolio can help to mitigate the losses. Diversification also helps to balance risk and reward. While some investments may experience high returns, others may underperform. By diversifying, investors can balance the risk and reward of their portfolio and achieve more stable and consistent returns over the long term. However, it is important to note that diversification doesn't guarantee success or protect against all potential risks. It's still important for investors to conduct thorough research and analysis before making investment decisions, and to continually monitor and adjust their portfolio as needed. In conclusion, diversification is a key investment principle that can help investors to minimize risk and achieve more stable and consistent returns over the long term. By spreading out investments across different stocks, sectors, and industries, investors can avoid putting all their eggs in one basket and achieve a well-balanced portfolio that is less vulnerable to market fluctuations. Warren Buffett's investment philosophy provides valuable lessons for anyone looking to invest in the stock market. By following these 7 rules, investors can build a strong portfolio and increase their chances of success. Remember to invest in what you know, practice value investing, invest with a margin of safety, have a long-term focus, be patient, avoid emotional investing, and diversify your portfolio. If you found this video informative, please like and subscribe to our channel for more valuable content. Thank you for watching.